Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to today's Cut to the Chase. Today is Thursday the 27th of October and I want to talk to you about the third quarter earnings season in the US. Before we talk about this though, it's important to place it into context. So clearly it's been a very tough year for equities. In the US, this has been driven by falling valuations while earnings have continued to expand. The current expectation is actually for around 5% earnings growth in 2022. This combination of rising earnings and falling share prices has brought valuations sharply lower, close to historical average. But as we look forward, there's two main concerns for investors. First, will valuations continue to decline and overshoot? In our opinion, this is quite possible in the near term, as we believe the pressure remains on the Fed to tighten policy aggressively, which will increase concerns going forward. However, on a 6 to 12 month basis, actually we expect the tightening cycle to abate, which may reduce the pressure on valuations. Unfortunately, the answer to the second question of whether earnings will continue to grow in 2023 or whether we'll see a sharp decline is less positive. At the moment, the market expectation is for over 7% earnings growth in 2023, so a slight acceleration on that 5% I was talking about for this year. To us, this seems on the high side, as we see a 75% probability of a recession in the US in the coming 12 months. Of course, Q3 earnings season is going to be an important data point and will be scrutinised for any clues as to what lies ahead. So, if we look at the earnings season so far, we're around just over a third of the way through the reporting cycle, with 189 companies out of 500 having reported earnings, according to Bloomberg data. At the aggregate level, both sales and earnings have marginally surprised on the upside, with numbers around 1% above pre-season expectations for both earnings and also sales. Of course, it's important to put this in context. These positive surprises are insignificant compared to the massive downgrade in expectations we saw going into the earnings season. So at the start of July, just a few months ago, third quarter earnings were expected to rise over 10%. As of today, that expectation is just over 3%. And analysts are actually still generally reducing earnings expectations for this year and actually also next. From a sector perspective, the strongest earnings beats have been in the healthcare, consumer staples, financials and energy sectors, while the industrial and communication services sectors have thus far failed to live up to expectations, i.e. they've been disappointing on the earnings front. On the latter, the recent news flow has also been pretty negative, with many communication services and technology companies indicating their concern about the earnings outlook. For instance, last night, Meta not only disappointed on the earnings front, it also guided analysts lower when it comes to Q4 earnings as well. Against this backdrop, we are not convinced that we've seen the low for equity markets around the world. On the positive side, equities are very underowned, and therefore it is possible that the recent rally extends somewhat in the near term. It also means that conditions are set for a strong rally once the fundamentals improve or even maybe stabilise. However, on balance, we still feel that there's another potential leg lower for equities before we reach that sharp and sustained rally, and we believe that earnings is likely to be the next shoe to drop. Well, that is all I have time for you today. As usual, Cut to the Chase will be taking a break tomorrow to make way for the CIO office's weekly Through the Noise podcast. I look forward to talking to you again on Monday. In the meantime, please take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.